Somewhat counterintuitively, we don't actually start with the income. The dividend is paid out of the cash profits. So it makes sense to us to start with that. And we're looking at cash profits because profit and loss accounts can be massaged slightly. The cash profit really reflects the underlying economics of the business. So we look at what the company does, how it makes its money, and where it's positioned in its industry, and its competitive strengths and weaknesses, to understand the durability, sustainability of that cash flow, and then to see how much it can grow, because the dividend is just that discretionary decision made at the end of the board meeting. Then our approach is to diversify the cash flows across about 50 companies in the portfolio, and we have hard rules to say that we have no more than 5% in any one stock and no more than 15% in any one sector to further diversify that cash flow. The objective of the fund is to produce durable, sustainable and growing cash flow and hence income over the long term. And we say the holy grail for it would be a 4% dividend yield growing at 5%. Since inception in 2000, the fund has delivered precisely that. In fact, slightly above 9% total return compounding per annum. And so we think it's met its objectives, and it's done so through a variety of market backdrops and with a lower volatility than the UK market. So overall, an attractive proposition, we believe. And in recent years, it's continued on that vein, and we have outperformed the majority of our peer group. When we think about key themes, it's important to emphasise where our strengths lie. And we believe our strengths are in understanding the bottom-up prospects for a company and its cash flows. So we focus on what we call the fundamentals. That is, the company's position within its industry and the prospects for that industry. Now clearly, what really matters within that is change in the industry itself. And the key catalyst for change, which is arriving faster and having more impact than historically, is technology. So we have built what we believe is a portfolio that is relatively protected from technological change and can even take advantage from it. That said, while we focus on the bottom-up fundamentals, we have to be what we call macro aware. And clearly there's an elephant in the room which we have to discuss, and that's Brexit. Our view on Brexit is that it has kept international investors out of the UK market, and that means that valuations are actually quite attractive relative to history and relative to other markets. So we're seeing quite a lot of attractive income available in the UK.